So, morning, Paul. Thanks for joining us today and giving us your time and expertise. Paul is an economist with Westpac Bank, and he's going to give us an overview of where our economy is sitting at the moment as compared to the rest of the world. So, Paul, tell us a bit about yourself.
Yes, thank you, Stephen. Well, I'm an industry economist, so I sit within the Westpac economics team, surrounded by macroeconomists, and I look at industry, and that's really my focus. But if you're looking at industry, you've really got to understand the broader economy as well. So that's why I'm here today.
Great, thanks. And before we dive into all the detail, Paul, can you just give us a quick flyby of where we're sitting at the moment as an economy?
Yeah, well, we think the economy's actually performed really well, to be honest. Certainly we're operating above potential.
The incentive that the economy got through the COVID packages, do you think that they've had a marked impact on performance? And is that likely to drift away over time?
Well, I mean, the way we look at it, it certainly is true that monetary policy has been expansionary, to say the least, or accommodative, let's say. Very, very low interest rates. They've helped to boost the economy. And of course, we had fiscal policy, which was expansionary. That was time-bound. That certainly supported businesses to keep labour. And there were other packages that came along. So certainly that helped us get through. Unfortunately, we have the legacy of that. So we benefited from that, but now we're paying the bill a little bit. And as our presentation, I think, suggested, was pushing through the pain of inflation that now results from that.
Yes, great. So you've got a number of slides you want to work on. So maybe you want to walk us through those and tell us a little bit about them as you go.
I suppose that the first slide that we're looking at really talks about economic activity and really talks about what you've just mentioned, how the economy has performed and the reasons for it. So you can actually see the impact of COVID. And yes, we've kind of bounced around a little bit. Up and down, and that was really because the economy is locked down and we couldn't go to work and all those good things. And supporting the economy, of course, was, as we said, highly accommodative monetary policy and expansionary fiscal policy. That has supported spending, particularly on things like durables. So we couldn't go overseas because we were locked at home, so we went and spent on fridges. And that happened quite a lot. And of course, we also saw at the same time very low interest rates boost the housing market. And in New Zealand, basically, there's a very strong relationship between the housing market, what happens in spending in the economy, and that has helped to boost economic activity. So economic activity has bounced around, but actually has performed relatively well given the circumstance, given the impacts of COVID, has been helped by policy. So there were a couple of other things that also came to play. So we've had a really strong housing market. We've had booming construction. We've also had a very good performance from our export sector. So our farmers, much misaligned farmers, have done really well and benefited from really high commodity prices, and that is starting to come off a little bit. And they've of course faced their own challenges. I think looking forward, so the economy right now, and I think the key message is the economy is actually performing above its potential. And when you have something, that really means that there is too much demand in the economy and too little supply following that demand. And when you have that kind of imbalance, you start to get the nasties come out. One of the nasties, of course, is inflation. Right. And we've seen prices rise quite considerably. Yes. And in response, we've seen the Reserve Bank hike interest rates. And that's that basically suggests that economic activity is going to slow over the coming wee while. So that's our kind of outlook.
Great. I see your predictions here on economic growth. You see by 24 that we're going to be well ahead of where we were pre-COVID. So that's quite encouraging.
Well, I'll take you back a little bit, and I should have corrected you at the beginning. It's actually level of economic activity that we're talking about. So certainly the level of economic, these are real numbers, so they're volume, they strip out price effects, and they do show, yes, the economy will continue to expand over that, but at a slower rate than we had before. And that's really important. That's really what the Reserve Bank, through its monetary policy and tightening interest, is trying to engineer, is this slowing down of the economy so that we don't go into a recession, but it's a what do they call it, a soft landing.
Right, fine line to tread too.
Very much so, very much so. It's a careful balancing act. Get it wrong, and you could actually send the economy into recession. Although that's not what we're necessarily picking.
No, and I certainly don't feel it with my clients. You know, they're performing very well. Their order books are full, so things are looking good. So moving on. The confidence in households, you mentioned that interest rates are going to increase, and this appears to be actually affecting the confidence of households. Earlier on, you said that as household prices increase, people feel wealthier and are more likely to spend, and they certainly did during the COVID time. So where do you see household confidence going at the moment?
The chart that we're showing right now shows that basically household confidence has fallen, has trended lower for some period of time. And with interest rates going through the roof, that affects people's back pocket. And then the ability to spend, it crimps discretionary income, or more than crimps given the rate of increases that we've had. And so people don't feel particularly good about their financial circumstances now and into the future. So this is a bit of a forward-looking indicator, saying, well, how do you feel in the future? How do you feel in a year's time? And they're saying, well, actually, given the way things are going, given high inflation and stories abound, given higher interest rates, actually, we're probably going to be in a worse position this time of next year. But I would turn that around a little bit. So while confidence has fallen, consumers are not feeling particularly confident. They're very confident that they're getting a good job. And that really refers to what I was talking about earlier, where you have too much demand or too little supply chasing demand. So the supply side of the economy hasn't been able to meet the excess demand because it needs labour to meet that excess demand, and that labour doesn't exist. And one of the reasons that the labour doesn't exist, of course, is because for a number of reasons. A key one is that the borders have been closed, so we haven't been able to bring non-New Zealanders into the country for a long period of time. So there are shortages, labour shortages, and that has certainly impacted on the ability or on the ability of the supply side of the economy to address demand, and by virtue of the fact it's easy to get a job.
Yeah, so that seems to be the single most constraint that my clients are experiencing across a number of industries, that they just can't get good qualified people to do anything, whether it be making a coffee or whether it be an expert welder, just can't find people.
Yes.
And that must be inflationary in itself, because there's wage
completely
inflation.
Right. Because that's the other thing, of course, when you've got demand for labour and it's just not there, you tend to push up the price of labour, which is, of course, wages. You see a lot of job hopping and that kind of thing that goes on. So certainly that's true. I mean, I've been talking to a number of industries recently, a number of firms, and they've been talking about difficulties finding labour. And it's really interesting because they're saying not so much semi-skilled, now that the borders are open. Even though the borders are open, they can bring people but it's not the skilled. Everybody's competing for those. And in a lot of our industries, we have quite high registration requirements, and that kind of puts them off. They can't get them in because they've got to come in, they've got to be trained up to New Zealand standards, and that's often difficult. So there are these micro issues that affect labour supply.
Yes. Do you see labour supply settling down at some stage?
Yes, over time, because the way we're looking at it is demand and supply will equalise over time, and as part of that equation, and supply is obviously much bigger than just labour. It's all the factors of production. You would expect to see that equate and some resolution. Having said that, though, we have a perennial issue in New Zealand. It's a structural issue where we do have a shortage of labour, even during the best of times.
Right.
We're no different to any other first world country in that regard, and we're all competing for this pool of workers, especially from emerging markets, and that's a challenge.
Right. So inflation. So your outlook there is inflation sitting quite high now, a record for some time now. So what's going to happen with inflation?
Well, inflation, of course, is I mean, it reached 7.3% in the June quarter, and we thought, well, it'll come off from there, and it didn't come back as much as we thought. We were wrong, but we were the least wrong. So it came back to, I think we had about 6.8, and it came to 7.2 on a year-on-year basis. And so inflationary pressures are really strong for the reasons I've outlined. Too much demand, supply unable to meet that demand. Some of that is tradables, what we call tradables inflation, which basically is imported. Some of it's domestically sourced. Now, this chart that I'm putting up now shows headline inflation, and in it shows inflation if you take out the volatiles. So that's things like energy prices, which tend to move up and down.
Right.
It's affected by the currency. But if you strip those kind of volatiles out, you can actually see that inflation is still, kind of mid-sixes, non-volatile inflation, for want of a better word. So it's really strong. So that inflationary impulse is strong. And a large part of that has to do with what's happening domestically in terms of what we call, as I said, non-tradable inflation. And a large part of that has to do with what's happening in the labour market and has to do with wages.
Right.
And the increase in wages that we're seeing at the moment. Right. So our outlook for inflation, and unfortunately we don't show it in this chart, we expect inflation to come off from these highs. We expect the tradables component to possibly come off faster. That hasn't been helped, though, by the exchange rate.
No.
Which has depreciated, and it wasn't something that we really and they originally anticipated the extent of US dollar strength.
Yes.
But it certainly has contributed. We have seen fuel prices moderate a little bit. That hasn't been helped recently by OPEC cutting production. And of course, the ongoing war in the Ukraine also contributes to that. If we look domestically at the non-tradable component, so we think tradables will come off, maybe not as fast as we thought, but will come off faster than non-tradable inflation, which is domestically produced inflation. Right. The issue there is wages now are becoming entrenched, and the wage expectation spiral. Yes. Wages go up, prices go up. I need more money. I need my wages to increase to pay for that, and it becomes a negative spiral. Yes. And we've got to break that. And the way the Reserve Bank breaks that is by hiking up interest rates. Right. So that's where we are at the moment. So we expect non-tradables to basically also decline over time, but will take a lot longer because of this cycle that we're seeing. And we're only picking probably to about 2024. We'll actually see it move within the 1% to 3% band that we've got in this chart. Right. Unfortunately, I'm not showing it on the chart, the outlook, but you understand what I'm trying to get at.
Yes. Thanks for that. So the dollar, you mentioned just a few minutes ago that the strength of the US dollars had a significant effect on both us and the Aussie and the British pound, albeit they've got political issues there as well. So what's happening? What's going to happen with our dollar?
Well, the reason I had this slide in was to basically confirm what I had or expand on what I had in the previous slide, which basically the impact of the dollar has actually contributed to tradable inflation. And as you say, a lot of that's been driven by US dollar strength. Massive hikes in interest rates over a flight to quality. So you've seen money moving out of markets such as ourselves, Australia, and into so-called safe haven markets. But that's been good on some respects. It's supported our exports and certainly supported our farmers.
Absolutely.
But it's been bad on in other respects, and it was one of the reasons why tradable inflation, because imported inflation has actually increased. So US dollar prices of crude oil, even if they've remained flat, basically have gone up in dollar terms because of the exchange rate. And yes, it certainly has softened, and it's likely to remain soft for the foreseeable future. As we see interest rate differentials disappear. And it's just the pace of hikes that we're seeing over there. It's tremendous.
So the US dollar's pretty much driven by sentiment. That they're seen as a safe haven, even when things are not going well in the US. They still go there when there's some impetus or some events happening around the world. So do you think that us down south here, Australia and New Zealand, will come back in favour as a currency at some stage, that sentiment will start to move back?
Yes, I do. The global uncertainties are massive. We do think that and this is the house view that's coming from Australia, that the US economy is set to slow. We will probably outperform that economy, although we will be slowing. Asset prices here will be reflecting the impact of interest rates, and we're likely to see a return to favour. But that will take a bit of time. It'll take a bit of time. It's not going to happen immediately.
Right.
Probably short term, we're likely to remain weak against the dollar.
Okay.
Longer term, a little bit more strength.
I'll keep an eye on my foreign currency trading. So the next slide talks about shipping container rates, and I know logistics have had a huge effect on production here, getting stuff here into the country, shortage of ships, which has punched container prices through the roof. But now you've got a chart here which is indicating that prices are starting to come back, which is great news. So can you tell us more about this?
Yeah, there's a couple of caveats around that. So again, I'm trying to basically expand on my inflation argument. So while we've seen non-tradables, tradable inflation has been strong. This is a factor that's likely to basically put downward pressure. So we've got some that are putting upward pressure, such as the dollar. This is putting downward pressure. I should warn that this is a global rate. So when it comes to New Zealand, and because we're far away from everywhere else, the rates may be coming off slightly, but not quite as much as what this chart is showing. So I think there is a bit of a caveat around that. I think so they've certainly come off. I mean, one of the things that this points to as well is the fact that during COVID, one of the reasons shipping rates went up was during COVID. Obviously, you saw the supply disruptions, but the other reason why it rose is because nobody was going abroad. So because nobody was traveling, they were spending on goods. So there was greater demand for goods, and you can only transfer goods by ship. So guess what? And there's only a certain amount of ships. You can't build ships in a day. No. So guess what? The prices went up, and that's essentially what happened there. But now, as we've emerged from COVID, and when I say we, I mean the world. And we've opened our borders, and people are travelling. They're now starting to spend on holidays, and so less goods. So there's less need to carry, and that's one of the reasons they've come down. Now, in the case of New Zealand, the issue there is about we're off the beaten track.
Yes.
You've got links and hubs and everything else. So you've got to actually have capacity on that second link down to New Zealand, if you understand what I'm saying. So there are still issues to be worked out. I mean, the other thing to consider here, so that's shipping rates, and normally in here I'd also would have put commodity prices, which have also started to come off as well. And that's also had an impact on when I say commodity prices in general.
Yes.
Specific commodity prices, they're still high, but they've started to come off, and that's a little bit from previous highs. And that kind of informs our non-tradables forecast going forward.
Some of the reading that I've done around shipping was over COVID, there was a massive mothballing of ships, and it takes a long time to get these ships back up to speed. And so the few ships that are working or actually plying the more favourable routes, and as you mentioned earlier on, we're down here and we're not favourable. But I guess as the supply starts to meet the demand on favourable routes, they'll go hunting for other opportunities.
There is that, and the other thing is containers. So when you had disruptions caused by, you ended up with containers all over the place. And you need containers to carry things. So yes, there's a shipping component, but there's also the container component. Supply chains were broken. I mean, one of the issues about supply chains is that, this really talks to my industry background, is that they've been built over time for efficiency. Maximize efficiency, reduce cost, but not resilience. So when we had this COVID shock, we ended up resilience was tested and broken, basically.
Right.
And that's why supply chains operated the way they did,
Yes.
or ended up being fragmented. Now they're being mended slowly but surely. And as you say, so there's two elements. There's the mothball capacity of ships, but there's also getting the containers in the right place at the right time.
Right.
And compounded on that, of course, we're miles away from anywhere.
Exactly. So moving on, the next slide is unemployment. That's at record lows at the moment. So, and as you have said earlier on, there's a shortage of labour, and that in itself has an inflationary effect, the wage inflation effect. So, what do you see happening here? And it surprises me that unemployment has continually gone off, even during these years of huge disruption, where we've had COVID and we've had political issues overseas, but inflation in this economy has kept dropping, except for a blip in 21.
Yeah, I think that shows some of the shocks. I mean, what we've seen basically is, unemployment's really low. I mean, record lows. We're looking at 3.2, 3.3%. It's been constrained by the fact that, it's been helped by the fact that people haven't been able to come into the country. So there's been jobs for everybody. If you want a job, you can get one. So that's basically supported it. And it really talks to this story, and it's linked to inflation. It's linked to basically how the economy has performed. This idea that the economy is performing above potential. So above potential, supply chasing demand. We need workers. There's only a pool. It's not being filled up from overseas, although that's likely to change as we start to open the border, or we have opened the borders. But how much it will change depends on government policy, of course. And that'll allow workers in, and we expect to see that unemployment rate start to rise, but not massively. Right. So unemployment really reflects the imbalance between supply and demand in the economy.
Right.
And that's what I was trying to get through on this slide. But as I said, we expect to see unemployment start to drift. Right. Or drift a little bit higher, but not in a significant way. And I've got a chart that actually shows that.
Right. So you touched on government policy. Do you think government policy at the moment is explanatory when it comes to immigration, or has it still got a lid on it?
This is still very uncertain. So previously we were bringing, I think, an average of about 50,000 people a year. The government has stated quite unequivocally that it favours jobs for New Zealanders, and there have been a number of other comments in that regard, and so we're in our forecasting assuming something closer to 30,000. So the government is going to allow people in, but maybe not be quite as open and laissez-faire, right. open to visitors as we might have had in the past. Right. Having said that, though, things change, and it's not beyond the realms of possibility that government policy could be far more open, open border policy. Right. But what we have at the moment kind of suggests that yes, the borders will be open. We will be allowing workers in, but perhaps not as much as we have in the past. So we see migration basically sitting in that 25 to 30,000 kind of level for a while.
So there's still going to be pressure on wages, and that's going to have its inflationary.
Yes. I mean, there will be, and one of the reasons is it's hard to get skilled labour at the best of times, but there's a number of micro issues that also support that as well. Right. And I made a mention of a couple of those earlier.
Yes. Thanks, Paul. So wage growth. Yes. So the pointers are all heading north. So, tell us a bit about this.
Okay, so we've talked about non-tradable inflation. We've talked about the key drivers really is what's happening in the labour market, and we know that unemployment is really low. There's a thing called a natural rate of unemployment, and typically sits at about 4%. Now, nobody knows where Nairo sits nowadays, but we're sitting at basically 2.2%, so we're really low. Even when you compare it to other countries, we're really low. that has to have a consequence. Now, with as again, I bring it back to this idea of this imbalance between supply and demand. When you've got too much demand in the economy, prices tend to go up, and that includes the price of labour. It's a big component of production, and we've started to see that. So this shows this chart shows the QES. Average hourly earnings in nominal terms is the red line, and you can see that's picking up and picked up quite sharply. I suppose the real key one is the blue line, which we've adjusted for inflation. You can see it's in negative territory. Now that basically takes into account inflation. So basically, the workers are getting salary increases, and then they're becoming increasingly larger. But inflation too is even bigger.
Right.
So guess what? On a net basis, they're actually worse off.
Yes.
But we expect, because of this expectation spiral, expectations of inflation, wage demands are going to increase, and because of the tightness in the labour market, we see further upside on wage rates.
Right.
And they're going to be passed through.
Right. So, employment growth. You've touched on this quite a bit in the last couple of slides, and it doesn't look. We've got pretty much full employment here now, and we don't see much relief coming in from overseas. So we're going to have a period here where we're not going to see significant employment growth.
No, we will see employment growth because employment is growing. More people are being employed. Participation rates are increasing, but unemployment isn't going to increase dramatically. Yes, we may see a little bit as we see more migrants coming into the country and more scope for unemployment, but it's really drifting off a really small base. And it's
Right.
The key issue there, though, is labour market conditions are tight. Job vacancies are up. Companies are screaming for labour. It's very difficult, and so you see price of labour go up. We've already said that labour costs are going to go up, and we expect them to go up further, and that's what this chart shows. I think it's got a peak in about 24, 25. I think 24.
Yes.
Is that 24 or 23? About around that period. So we're expecting to see wages continue to grow. That's part of that expectation spiral. And that's really what would worry the Reserve Bank. How do you get on top of that? It's a spiral. It's a noted economic phenomenon. You see that in a lot of different countries. And it's about breaking that. So there's an inverse relationship between inflation and unemployment. It's called the Phillips curve.
Yes.
It's inverse. So basically, when unemployment is low, inflation's up. Typically, as a rule. So you've got to try and break that relationship, and you can do that in the long term. And that's what the Reserve Bank is looking through monetary policy.
So if you're a worker in a factory at the moment, and on one hand you can see that there's rising pay, and there's good job opportunities out there, so you're feeling a little bit of comfort about that. But on the other hand, you're struggling at home because your interest rate on your mortgage is increasing, and inflation at the supermarket, whatever you buy now, is increasing as well. What have you got to say to the average worker out there in the factories, and what's their future looking like over the next year or two?
Well, actually, we're going to talk about mortgages just now because we would make an argument that actually the rise in mortgages is going to have less of an impact than you might think.
Right.
But we do think that workers are in prime position now to basically take advantage of higher wage rates, and that will support spending going forward. Right. In fact, we think that while we agree that we think spending is going to come off, we don't think it's going to be as dramatic as one might have thought. Right. And that suggests that the economy is going to slow more gradually than one might have thought. And certainly, so that's a basic.
So it's going to be a very soft landing.
Well, we think it's going to be a soft landing. But it's a trick, and we may be wrong, because you could have a recession. And we'll talk, I've got a chart at the end of this presentation where I talk about what's a recession, what's not a recession. Right. Because we have some really strong debates within the team about that.
Great.
And
Look forward to hearing your opinion there. Yeah. So the OCR, which drives interest rates, is the next chart.
Yeah. So this is a really scary chart. If you're a consumer, now, obviously with inflationary pressures increasing, too much demand, too much supply chain, too little supply change and too much demand. Inflation's on the rise. A lot of that's got to do with what's happening internally in terms of domestically creating inflation. The Reserve Bank has stuck up interest rates, so it's put up the OCR, and it started hiking in October last year, 25 basis points. So we started off really, really low OCR of 1%, and there were a couple of increments, and we at the time were arguing for a lot stronger than that because we were already seeing demand coming through, but there wasn't that much. And when it became apparent that, hey, the demand pressures are really, really strong in this economy, we've actually got it wrong. Monetary policy. The whole thing about it was that the COVID, that the shock from COVID was a supply-driven disruption. It wasn't a demand-driven phenomenon. It was about the supply side, and that was very different to most other recessions. I should have actually mentioned that right at the beginning. Be that as it may, so we see interest rates rising. And as demand side pressures have become much more evident, that's been evidenced through higher wage rates, lower unemployment. We've actually seen the Reserve Bank hike its interest rates, and basically that's followed through to retail rates. We've updated recently our interest rate call to reflect, and that's reflected in this chart. So you will see that basically the next Monetary Policy Committee, which is in November, we're seeing a 75 basis point hike, which is unheard of. And the real reason for that is because we're not seeing the impact of higher interest rates coming through on the real economy. We're just not seeing it. And we'll go through the reasons why, but we're just not seeing it. And that's evidenced in part by the fact that we've got inflation sitting at 7.2%. We would have expected inflation to have come off. It's earlier for the 7.3%, I think it was. Yes. We would have expected to see it come off a little bit sharper in the September quarter than it actually did. Right. At the same time, economic activity has remained buoyant. So the latest print that came through, I think it was 1.7% year on year, was significantly higher than any of the economists were thinking, even ourselves, and we were again less wrong than most. But we were on the positive side, so we took that as a badge of honor. Yes. But the economy is still performing well. Yes. So again, that excess demand is still there. Right. It hasn't reacted to lower interest rates, and there's a number of reasons for that, and I'll go through those later on. So now we're seeing, so we think they're going to hike quicker. Hike by bigger amounts. So I think we've got a 75, a 50 in February, and I think a 25 in April. I think that's a 25 basis point hike in April. By that time, we should be really on top of inflation. So tapping out at 5%, which is quite high if you compare where we're really in tight territory. Yes. That will have to be there for a while so we can get on top and break that expectation spiral. Right. I would suggest, point out that in this slide I've also, and maybe I should have taken it out, was I've got the Reserve Bank track, but that was reflected in the August monetary policy statement. We haven't had a monetary policy statement since then, so we haven't had any updated track, but that's likely to go up in the next MPS. Right. But be that as it may, I was just there for sure. But significantly, we've moved moved interest rates higher. Right. 5%. Yeah. So
that affects mortgage rates, and we've had a little bit of discussion on mortgage rates. So
yeah, so that as I said, that's passed through to the retail rate. So as this chart shows, it shows your 2-year and your floating rate, and you can actually see that how they've moved up. But I would point out a couple of things here, and it comes back to my point that actually that suggests that basically the impact of interest rates, the effective interest rate, isn't quite as high as we might think. And one of the reasons for that is that we can see that they've moved up sharply. 70% of the mortgage book, roughly 70% of the mortgage book, so the structure of the mortgage book, I can't remember the exact amount, but the vast majority is fixed. About 70% of that has already repriced. So it's already refixed over the last year. So if you look at the last year, the way interest rates have moved, so they've actually moved, so they've actually still been able to reprice at relatively low rates.
Yes.
So the impact of those interest rates, they protect themselves. They may be paying slightly higher. They may be paying, instead of, I don't know what, let's say 2.7%, they may be paying 3%, whatever it is. But it's just an illustration. But
Yes.
but it's quite marginal.
Yes.
So they're yet to be affected, and that may be one of the reasons why we've yet to see the full impact. Because if you look at the rate of increase from 1% to whatever it's 3.5% now, that's quite a big increase.
Yes.
But we haven't really seen it.
No.
I say we haven't really seen it. Where there are signs, and I will refer to those. But that's one of the reasons. So that repricing behaviour certainly has had an impact, has reduced the effectiveness of interest rates. That's not to say monetary policy doesn't have an impact. It certainly does. And we expect to see that come through over the next year.
Yes, but it is quite latent, as you say, because people have fixed. So it takes some time for those increased rates to actually filter through to the market and affect the consumer spend.
Yeah, they've been repricing, so they've been refixing off the lows. So they've moved from very low rates or ultra low rates to very low rates. Well, so what?
Yes.
They can handle that.
Yes.
The trick is, in a year's time, those rates will have moved considerably higher, or the rates that they'll be paying when they have to reprice in a year's time will be considerably higher.
Right.
That's when they'll get caught, that's when you'll see the impacts.
So house prices, they've come off quite a bit, and I suspect the threat of higher interest rates is bringing that back. So do you see this trend going forward still coming off?
Yes.
You do?
Okay, so the issue here is, higher interest rates have had an impact. Let's be honest. But that's on new house purchases. If you're sitting in the house and you're refixing your mortgage, less of an impact. But when you're buying a new house, absolutely it's going to have an impact, because now you're buying in at a higher rate. So absolutely it's going to have an impact. And so we've seen house prices come off. So when COVID started, the OCR was cut. We got down to 1%. House prices went through the roof. And we're talking 40%. There were some reasons like the Manawatu, Gisborne, Hawke's Bay, just shot the lights out. There wasn't one region in the country that didn't do well. The only ones that you could perhaps have a look at would be Otago, basically because that was affected by tourism, the West Coast, and perhaps Canterbury underperformed, but there are a number of reasons for that, and I can go through those. But certainly they were slower to react to that hike, but they have certainly seen bigger house price increases. Now that we're through the most of the COVID, most aspects of COVID, we're now starting to see interest rates being hiked because of higher inflation. That's certainly had an impact on house prices. And of course, there's other things like the bright line test and that haven't helped. LVRs that don't help either. And so we see prices come off. Now, to date, they're probably, we're looking at currently we're forecasting, and I use the word currently advisedly, 15%. We're re-looking at our forecasts, and we think there's scope for more. So we think that the price declines are likely to be significant.
Right.
And that's really important, house prices, and I'll talk about those on the next slide. But looking at this slide, some of those house prices, Auckland shot the lights out. You can see the big decline. The declines have been biggest in our biggest cities, Auckland and Wellington in particular. Less so in our regions, which is quite surprising, because we thought, well, they went up on small volumes, they should come down on small volumes. We haven't really seen that to the same extent. That's not to say they haven't seen big reasonable size falls. They have. Right. But Wellington is the worst performing region in the country. Canterbury is slightly different. As I said, it was late to the party, so we saw price increases late to the party, and they've come off a lot slower. A lot of that, though, has got to do in broader Canterbury rather than the city itself. The city, they've actually come off quite sharply.
So this will affect new builds as well, I guess. And so for the developer at the moment, it could be uncharted territory or nervous times.
That's correct, and we will talk about that in a couple of slides' time when we start talking about consents and residential building activity. But certainly, when you've got price declines coming like that, the return, the equation changes. This is the revenue you can get because the prices have declined, so your revenues fall, your interest rates costs are going up. So basically, your revenues and your costs, basically the gap is narrowing, so your returns are not there, and that obviously has a negative impact on developing property, certainly so, and that would over time have an impact on construction activity going forward.
And it has an inflationary effect as well.
It certainly does, and that's driven to spending. So this chart shows which shows disposable income. It shows house prices against per capita consumption spending. So the purple bars are per capita consumption spending. House prices basically here are shown 15%, so you can see the big drop. But you can also see that basically spending tends to fall. So when the house prices go up, spending goes great guns, and that's that part of that excess demand in the economy.
It's a feel-good effect, isn't it?
Oh, very much so. There's a wealth effect. We'll feel good, we'll go out and spend. Yeah, I'm rich.
Yes.
I'm sitting in my $1 million house, spend. And there are a couple of other reasons as well. But yes, that's certainly true. But when prices fall, we go down in the gums, consumer confidence falls, actually regional confidence falls, to be fair. And we see spending decline as well, and spending come off a little bit. And you can see in this chart that spending is coming off, but not to the same degree. And there are a number of issues around that. Now, we've touched on one with the order book, the structure of that, the repricing behaviour. But there's a couple of other issues. We've been saving as New Zealanders. We started saving. We haven't been particularly good savers in New Zealand, but actually we have been saving, and we were even saving before COVID, small amounts, and that's kind of picked up over time. I should also point out that so that's helped to provide a buffer. So the other thing is people have in terms of their mortgage repayments, have actually been paying more principal. There's a large proportion of people that pay a lot of more than they need to in terms of the principal amount on their mortgages. That gives a little bit of buffer. So when interest rates go, there's more from the principal into the interest. And the other thing, of course, is when you look at household balance sheets, they're in pretty good shape. And they've been boosted a little bit by the fact that actually incomes over a long period of time, and that's income from all sources, so that could be equities or whatever, have actually outperformed the CPI. So there's a bit of a buffer there. And what that means is basically that although we've seen higher interest rates, we've seen house prices come off, spending has basically been supported, hasn't come off quite as much. So spending has been supported. And that's an important consideration. It's not all doom and gloom for the homeowner, for the consumer. And that's important because if you go on to the next slide, which really looks at spending, you can see that even though we've had COVID, even though we've had higher interest rates, spending has actually been relatively strong. Now, it has started to dampen. That's not to say interest rates haven't had an effect, but it hasn't been. When you consider the amount of that interest rates have hiked from 1% to 3.5%, with the expectation of more to come, with inflationary pressures, you would expect to see spending come off a lot more. It hasn't really. It's come off a little bit, and this chart basically shows Auckland and New Zealand, but you can look at it in any region. Basically, there's an indication that spending is coming. That higher interest rates, that monetary policy is starting to have an impact on spending, and you can certainly see that in that chart there.
Do you think the average household nowadays, with all the information that's available at their fingertips around our own economy and the macro economy and the world economy, do you think we're a bit more resilient to change now? Whereas once upon a time when information was slow to get into the households, a bit of bad news stuck around for a long time. You think nowadays that we have seen a number of major events happen and we haven't died, we're carrying on. Do you think people have built a bit of resilience to economic change?
I certainly think that is the case. It's about adaptability to change and the ability to understand the impacts and move with it. So technology basically provides information, it provides knowledge, and basically consumers so they're much more informed than they used to be, and able to make choices as they see fit. It creates adaptability. I call it nimbleness, and to be able the ability to respond to adverse economic circumstances has certainly improved through the access to technology and the like.
Great.
So the next slide, I suppose, I really wanted to make this point that spending. Now this looks at electronic card transactions, which is effectively a spending, and it compares it to pre-COVID. And I've got the level of 100 there, and it breaks it down by type. And what this basically says is that spending patterns have changed. So during the COVID, it was really durables and consumables that led the charge. So as I mentioned before, during COVID, we were stuck at home. We couldn't go anywhere, especially in Auckland. So we went and spent on new fridges and new computers and new TVs. We couldn't go out to eat.
No.
But now, of course, with COVID, the pandemic and the restrictions haven't been lifted, and the COVID hasn't gone away, we're able to go to hospital. I need to say hospital. We're able to go to the to restaurants. We're able to socialise. That's boosted hospitality. So you can see in this chart, the purple line, basically, it's actually increased dramatically, and it actually sits well above now the pre-COVID levels. So hospitality is doing relatively well, and that was in the doldrums for a long period of time, and lots of firms closed as a result, despite government fiscal policy and some support. It could have been a lot more without it, to be honest. So part of that hospitality story is also driven by the fact, and this is important, is that we've seen more tourists coming into the country. And actually the pace of tourism growth has been quite strong. We've got 120,000 tourists coming into the country per month now. That's on the increase, or set to increase further, and that's supporting the hospitality sector.
Great. Yes, my hospitality clients that went through terrible times and very stressful times are now actually booming and doing way better than they actually could imagine that they would have done.
And that chart kind of supports that kind of idea.
Yeah, absolutely.
So the other area of the economy that's really done well and certainly supported and continues to support this economy, and that reflects that excess demand above potential growth, has been in construction. Construction in this country has absolutely boomed. Now, this is residential. The graph I'm showing here is residential building activity. It shows consents, and it puts that up against spending, residential spending. And you can see that basically that there is they tend to follow each other, but it's kind of split. And that's largely because of the change in circumstances, the high interest rates. It puts people off. So we're likely to see some of those building consents not filter through to actual work. And that gap's going to widen a little bit perhaps, or that's going to become more of an issue. But we're still pretty positive about construction, and in large part that's driven because a lot of work has been delayed. So there's a big pipeline of work, and I talked to the construction industry, and they're all telling me that conditions are good. They say there are challenges around supply chains, labour remains an issue, but it says that the order books are looking good, and we foresee that basically construction activity will remain relatively elevated, in part because of the delay in works. But as building consents, and we do expect building consents to come off more recently, as building consents come off in the next wee while, we think that that will translate into actual work on the ground. So in the short term, when I say the short term, the next year or so, we think that construction will remain elevated, albeit at similar levels to they have in the last year, right. And they will come off thereafter as reflecting the unexpected decline in building consents. And that building consent picture is really driven by high interest rate environment that we're going to be operating in.
Before we went into COVID, there was a nationwide shortage of homes, and we had the phenomenon of people doubling up in houses, extended families living together. Has that pent-up demand that was there before COVID, has that been satisfied to some extent with the low immigration and building activity still being strong?
The short answer is yes. Certainly, we've seen a lot. We've seen an erosion they've actually not the erosion. That's maybe the wrong word, but we've certainly seen the housing shortages, particularly in places like Wellington and Auckland, and that's where they're most acute, particularly in Auckland, but also in Wellington. Those housing shortages been eroded, and quite a way. And in part, that's also been driven by, we've also seen people leave those particularly Auckland, and into moving into the regions. But certainly, the amount of construction activity has eaten into that. I don't have the exact figures on me, but I've been told that basically it's been quite significant. Where there is a chance that in the next couple of years we'll actually be building too many houses for the shortages
which is great for the consumer.
Which yes, of course, yes, maybe not so much for the contractor, residential, or the developer.
Exactly. Right, population. We've touched on this, and your graphs, your long-term outlook is for population change to be slightly downwards.
Yeah, so there's a couple of things here. So the reason this chart's in there is to support the construction sector. So one of the reasons why construction has done so well is in part because we've attracted a lot of migrants. Admittedly, not recently, and there's that big dip, and that big dip's been because the migration basically there's four legs of the stool, so to speak. One basically is incoming New Zealanders. The second one is outgoing New Zealanders. The third is incoming foreigners, and the fourth one is outgoing foreigners. Now, during COVID, we saw an outflow of New Zealanders, and they still continue. So we saw, you might have seen in the media, them saying, well, we've got a brain drain. Well, bad news, we've always had a brain drain. They've always been leaving, and that hasn't been any different. It hasn't increased. It was always there. They could always leave. There might have been some hesitation by some, given the COVID environment, but generally they could always leave, and they were leaving. Foreigners could leave as well, and they wanted to go back home because they wanted to be with their family, given the state of the pandemic, and they also left. Kiwis would come up flooding back home. But what was missing, and why the reason we saw that big negative in migration, was the fact that we weren't allowing foreigners into the country. So that's why but now that's been relaxed, and now we're starting to see migration start to move to zero, net migration move to zero, and actually start to edge into the positive. Now our forecast there, as you see, is between 25 and 30,000, and that's that's what I was referring to earlier. That's driven really by government policy. We're not who knows what they're going to say, but given past announcements, we're suggesting that basically it would sit a little bit lower than what we had previously, which would probably double that. We're sitting at about that 25,000. So we do expect migration to slow compared to what we might have had, or to be lower than what we had previously. That's that kind of view. And that also feeds into the housing market, because obviously we've got to build houses for them.
Exactly. So a nice soft lift-off in immigration is much better to address with resources and housing, etc., than a sudden spike and everyone wanting to come here.
Well, the thing is, it's a highly competitive market for foreign migrants. We're competing with other countries that also face similar shortages. We have certain advantages, but we have certain disadvantages, and so we're competing with them. And one of the areas of concern I might have mentioned earlier is the registration requirements for highly skilled professionals in some professions. That's a big, our standards are very high in some areas, and just dissuades people from coming and puts them off. I was talking to a contractor, building contractor yesterday, who was saying we can get semi-skilled labour, no problem. But skilled labour, because of that
Yes.
registration requirement was more difficult. And also Australians are basically looking to New Zealanders, skilled New Zealanders, to go over there.
Yes,
So the competition is on, and
hot.
we're certainly struggling. It's certainly a fight.
Agriculture.
Yeah, so I'm not an agricultural economist, but I will refer to this. So I talked about earlier about the performance of farmers. They've been a massive support to this economy, and they benefited significantly from high commodity prices. So dairy prices gone through the roof, or has gone through the roof. It's recently softened. Meat prices had been affected by COVID, delayed impacts on processing, but they remain at elevated levels. And they're really driven by what happens in global demand-supply dynamics. In the case of dairy, it's all about China. What happens in China and the Chinese consumer. And then you've got forestry prices basically coming off slightly, but still remaining at relatively high levels, despite some of the issues that China's had in its construction sector and property sector more generally. So agriculture's done well and have been a real boost to the economy. But as my slides say here, they're facing their challenges, as are other businesses facing challenges through higher costs. They are also facing fertilizer prices are through the roof. The currency has fallen, so that affects a lot of it's imported, but not the components are imported. I know we produce fertilizer here. So they're facing higher input costs, and that's squeezing their margins a little bit. So although they're doing well, they're under a bit of pressure. And of course, the other thing facing the agricultural sector at the moment is the townies don't like them, although they feel as if the townies don't like them. And they're under the whip from a whole spate of regulation. In terms of mostly related to their operations, environmental issues, and they feel as if they're under attack, rightly or wrongly. And that's certainly been seen in the proposals on carbon emissions, and the depth of feeling seen recently, I think, with the groundswell protests. But yes, they do, and they are quite angry. So, and they're not feeling, as a result of that, they're not feeling particularly confident about things. Or but you could argue, have you ever seen a confident farmer? They tend to always be grumpy. But this certainly is the case.
Yes. And I guess for our economy, a minute ago you mentioned that tourism is picking up again and significantly picking up. So the softening off in the agricultural sector from a macro point of view will be offset by the growth in tourism.
I think it's a bit. I don't think we should say that agriculture going forward is going to do poorly. It's still going to do well. The farmers are still going to do well. The dairy price is likely, and that's shown on the next slide, which shows basically. I've just put these two charts up, which shows dairy prices and lamb prices. You can see that they're raised. Yes, the forecast price for dairy is off a little bit. But, they're running at, I can't remember the exact figure, but it was over $8. Your break-even level was about $8 for a dairy farmer. So they're still making money at these levels, and they're making good money. But yes, they're not feeling good about life, and they feel under threat and the like. Kiwi fruit farmers are doing horticulturists are going great guns. But they also face a few challenges, particularly in key source markets, not least the Chinese producing infringing property rights and producing their own gold kiwi, and that's having a negative impact. And so one of the reasons why kiwi fruit did so well was because during COVID the health benefits came to the fore, and that helped to boost demand. But now that COVID has kind of receded, it's come off a little bit, but prices are still high, still elevated, and orchardists are likely to do well.
We recently sold a family farm which had been in our family for 115 years, and I look at the lamb prices now getting up at $180 a lamb, and we thought 110 was Christmas.
So
certainly gone through the roof since then.
Certainly has, and you see that in beef prices as well. Beef prices have shown similar characteristics. So the next slide here, I just wanted to refer to this briefly. Was we always talk about dairy prices being so strong, meat prices being strong, and they are, and they're elevated, but they also face big price pressures, like the rest of the economy, and for very much the same reason.
Right.
They're a business like anybody else, and they're under pressure a little bit from inflation.
Of course. So tourism.
So the other leg, I suppose, is that while we've seen the economy perform well off the back of consumer spending, and that's related to the housing market, low interest rates, what were low interest rates, booming construction, strong export performance. The one thing that was missing, that kind of masked the loss of tourists. So tourists account anywhere between 3 to 4% of the economy, which is a big whack. When we closed the borders, we had no tourism, but those other sectors actually offset that, more than offset that. So they did really well. But of course, as we've relaxed the borders, far behind anybody else, so we've been Johnny come lately, we've now started to see foreigners return to the country. Most of those have been Australians, to be honest. Been Australians and Kiwis returning home for friends and family. And Australians actually have outperformed our own expectations because we look at those separately. But yes, I've been really strong. We think there's still some upside for that. We think that some of the forecasts out there are maybe a little on the pessimistic side. We're a little bit more optimistic, so you can see that in the chart. We are, we're obviously we revise these forecasts. So, but yes, so the big uncertainty. So that's important. So they're coming into the country and they're spending and they're supporting the spending side. So when we see housing market affecting consumers' ability to spend, and we've said that consumer spending it's been offset a little bit by tourists coming into the country. And I suppose that's the key point.
Right.
I think in terms of our forecast going forward, we are pretty positive. I suppose China is the uncertainty there, because although Chinese people can leave, the zero COVID policy after the latest Congress kind of said it's going to stay. No. So what does that mean? So when they come back to China, so when Chinese people return to their country, they've got to go through rigmarole, an extended quarantine period, and it's just not worth it. So we're not seeing any foreigners. So we're not sure when they come back. We're assuming probability starts in 2023, going into 2024. Because there are some signs that even with a COVID zero policy, there is some relaxation around restrictions in China. And I can't remember the name of the town. I do. I can see it. I just can't remember it. It's got a funny name. But be that as it may, that's probably our big uncertainty at the moment. But we're pretty positive on tourism. We think that will support the economy. So you've seen it rebalancing away from domestic factors to more external factors now, and more basically going back to where we were like before.
Right. So in New Zealand, the load factors have picked up to where they were pre-COVID.
Yeah, so this kind of backs up my previous statement. So what are those Australian visitors looking like? So we're basically looking at capacity utilisation. You could actually see the capacity utilisation on Air New Zealand. Air New Zealand is bringing capacity on all the time. And it's very measured, and you can see that. But demand is there, and you can see that in the capacity. 90% load factors are very high in the industry. But you can see that even in Qantas as well have similar rates. And you must remember that that Virgin Australia is about to re-establish links in November. We've got carriers coming in from America, Canada. We've got extra links on reconnections with old routes, and then we've got new routes opening up. So it's all expanding, and that's really what I suppose this chart really refers to.
Which is great for those that want to go on holiday. Hopefully, we'll see airfares drop back a bit.
So yeah, I think that's probably got more to do with the hedging policy of airlines and the price of jet fuel.
Yes. So the paths of adjustment, this is an interesting graph. Can you tell us a bit about this?
Yeah, so I think what I'd like to say is, at this point, is that our view is that the economy has basically performed better than expectation. We've ended up in a situation because of policy, supported by policy. We've seen the economy perform above its potential. We see the economy slowing in the future off the back of higher interest rates. It's managing those higher interest rates to bring us. If you operate above potential, you tend to generate negativities, and one of those negativities is inflation. So if you look at this chart, we show an actual GDP above potential GDP. So potential GDP is a non-inflationary GDP. Well, it's the inflation GDP. You have inflation between 1% and 3%. Right? It's manageable. But we're sitting above that, so we create inflation. So you could almost say the gap between the two is basically the impact of it is inflation. So the question then is, what is a recession? We see this in the press, and we always see this, and they always say, "Oh, we're headed for a recession," right? And then the question is, well, you could have 2 quarters of negative growth, which is the technical definition of recession. It came out of America, actually, but so we apply that. That's the applied. But if it takes you from above potential to potential, you're not you're just growing at a less rate, but you're actually growing at a more sustainable rate.
Yes.
From an inflation point of view, is that really a recession if you've contracted by 2 quarters? We would argue no. Exactly. We would argue that inflation is what you saw in the GFC, which but that was a demand side crisis. But basically, there you saw the monetary policy reaction, and you saw the economy come in at below potential. To us, that is a real recession.
That's a recession.
So there you see it. There you see it 2 quarters. So I just wanted to bring that out because a lot of people look at it and say, "Oh, we've got 2 quarters." We're going, well, actually, that's not quite true. Or from our perspective, anyway, we would argue the case. So that is really our kind of view on the economy.
That's great to hear, because that engenders some confidence in where we're going. And you're right. There is a fair bit of doom and gloom out there, but I think it's probably misrepresented. And it's nice to hear your take, or the Westpac's take, on where you think GDP is going, and it might come back a bit, but it's not recessionary at all.
Yeah, that's not to say that recession cannot happen. I mean,
you've got to hedge your bets, don't you?
But there's an equally good chance that it won't. And certainly to date, we're not yet seeing any signs of that. We are definitely looking at a slowdown, though, and a significant slowdown in that. But not crash and burn. Yeah, not crash and burn. That's correct.
So if we dialed back to early 2020, we were starting to get a bit of news coming out of China about this virus and the effect it had. And I know my clients in the media business started to see a softening as early as November, December 19 in advertising space and things like that. So if we were sitting here now in February 2020, could you have believed where we've actually landed after all this, after we've got through COVID and all the effects of that? Could you have believed at that time that we would have been as well off as we are now?
Yes.
You did.
And in fact, we did. We did I don't say that at Westpac.
Of course.
We did I was speaking at a conference with a number of other economists from the other banks, and they asked us it was the Waikato Chamber of Business, and they asked us basically to talk about whether they saw a V-shaped recovery, what kind of recovery, and this was actually in about August of 2020. And we actually said at the time it's likely to be a V-shape with a couple of undulations thereafter. And we were actually...
You were bang on.
Well, we were and we weren't. I mean, there were things that caught us by surprise. I mean, we're fallible just like anybody else. But certainly we looked at that V-shaped recovery, and there are all kinds of shapes that people were talking about. Okay, or every word of the alphabet. But and it was quite surprising because the rest of the audience, and I remember looking at it, said, "How many do you believe?" And only 2% thought it was a V-shape.
Really?
So most people were expecting the worst.
I know.
But I think we're probably more right than wrong. We thought it was going to be a V shape. We were caught out perhaps by the secondary impact of a second lockdown and the like, but actually probably weren't, because we learnt from the first. But we knew we were undulated, so we weren't that surprised that we actually outperformed what we thought what could have been. A lot of that has to do with policy. Government policy at the time was very fiscal policy. We would say this, though. When you look at COVID was a supply side shock, not a demand side event.
Yes.
We reacted, the Reserve Bank reacted as if it was a demand side event.
Right.
As they would have done in the global financial crisis.
Yes.
To be fair, so did every other bank across the sea. And we're paying the price for that now in terms of higher inflation.
Yes.
But it certainly did help to boost the economy.
Yes.
And the economy certainly did. Maybe a little bit better than we thought. But we were not that far off.
I think most of my clients would say, well, the slight downside of that boost the economy got through fiscal and incentives is certainly a lot better than if they actually clamped down.
Yeah, absolutely.
And so we've come out of it pretty well. Yes, Westpac got it right. I can remember your graphs back then, and it was the only glimmer of hope out there. Certainly from our point of view, from our clients' point of view, and the general chat around the economy was that this is going to be awful. It's going to be a really bad landing, and we're going to see soup kitchens. We're going to see all sorts of things, and we've come out of it really, really well. And so I hope we come out of the Ukraine effect as well with regards to the ongoing effect of fuel prices and food. And one would hope that will settle down over time, even if they don't quite get the war sorted out.
Yeah, that's hope.
Yes. Well, Paul, thank you very much. It's been a great session. You're well versed in all the subjects we've talked about before. Your expertise is top class, and we really appreciate you taking the time to come out and have a chat with us and with our clients.
My pleasure.
Thank you.
I hope you enjoyed it.